HIMS House, episode 19. I'm Jonathan Stern. I'm here, as always, with Lewis Stevens and Dr. H. We have a special guest today. He is a former sell-side analyst, goes by the name Jack, and we will leave it at that. Jack, welcome to the show.
Hey guys, thanks for having me on.
Do you want to offer just a brief background, and then we'll launch into discussing hims and hers?
Sure. I was a sell-side analyst for the majority of my career, over 10 years on the street. Also worked in industry for a couple of years, and have followed the HIMS story since about 2022.
I think most of our audience is familiar with the financial industry, but maybe just a brief overview of what the sell side is, and then contrast it with the buy side.
Yeah, so the sell side, your role as an analyst is to follow a handful of companies referred to as a universe. Typically, it's in pretty defined sectors, although sometimes there is some drift within your coverage universe depending on banking relationships. And in that role, you really get paid for process more than results. So you're not really a stock picker. You're there to help be part of the mosaic of information and resources that the buy side or professional investors use as part of their investment process. So we'll touch on the news today or the report today, but you get paid for process. You're there to help your professional investing clients better understand the story, risks, opportunities, what might move the stock. There are a number of ways, deep dives, there's access management, whether it's conferences, NDRs, which is a non-deal roadshow, surveys and the whatnot. But you're not taking a position. The bank isn't taking a position unless they're making a market, and even then they're not taking directional bets. You're there it's a services role, so you're serving the buy side client. And on the buy side, that's your professional investors, hedge funds, mutual funds, other professional money managers. They're in it for their P&L. They're trying to generate a return. It's not the case on the sell side.
Jack, did you start following the HIMS stock out of your own personal interest, or was it kind of assigned to you through your work?
At first, it was personal interest, and then it became a professional relationship.
At what point in 2022 did you start following it? Was it early, like January 2022, mid, late?
Yeah, early. I started really following the story actually probably late 21, and then it certainly picked up when they hired Yemi.
And what compelled you to get into the narrative?
I thought it was going to be a really fun stock to follow. Debates get client interest. Client interactions are monetizable. It's just I think it's a really fascinating company, right? I mean, you get in, you follow companies for many different reasons. First and foremost, because you think it'll be good for your franchise. But I think what they're doing is really interesting. Living inside of the high deductible. I think that's one thing that maybe some folks don't fully appreciate, is that you can create a consumer company inside of the healthcare industry because there are dollars that patients are spending out of pocket. The more dollars they spend out of pocket, the more they turn into a customer versus a patient. And customers behave differently than patients. And what HIMS has done is create a fantastic customer brand and experience that patients or customers believe is worth paying for.
I did want to start, Jack, with the news that came out this morning. Bank of America released a note today predicting HIMS revenue. Can you all hear that?
Oh, yeah.
It's all good. You can leave that in, Johnny.
Yeah, leave that in.
Let's leave that in. Bank of America released a note today predicting HIMS revenue will come in $30 million light in Q4. Now, this projection is based on Bloomberg second measure credit card data. For you, Jack, could you give us your quick reaction to this note when you saw it hit the wires from Bank of America?
Yeah, I thought it was interesting, right? I used to do an analysis that looked at web traffic and app downloads, and that analysis worked until it didn't. Credit card data is usually a pretty good indicator. Directionally, it's a great indicator, but getting precise with it is a little difficult. One of the things I had issue with the Bloomberg data, and I've tracked it as well, is that the error drift, so the difference between what the credit card data says versus what they actually end up reporting has widened quite a bit since probably the first quarter of 23. And so it's tough to try to run a tight correlation on it. I think the R squared in the report was sub 0.7. When your deviation is moving around like that, you start to worry about the quality of the sample and if there's consistency within the sample. This is kind of getting into stats land, but I mean, look, it's an interesting analysis, and I think the thing that was really interesting in the report was they tried to take a stab at what the deferred revenue impact was going to be and make an adjustment from there. So for anyone who's not familiar with the deferred revenue adjustment, so if you're signing up for a 1-year subscription, right, that credit card's going to get charged for the 1 year's worth of product. Let's say it's a GLP-1, $169 a month, right? So that's 169 times 12. So that hits the card. And if you're not getting all 12 months worth of product delivered, let's say you're getting 3, you're going to have a deferred revenue impact of 9 months. So 9 times the 169 that is going to live on the balance sheet and is not going to be recorded as revenue. Really interesting is how they approach that. And I do think that's something to consider as you're looking at the credit card data come in, and certainly at the beginning of this month. That being said, again, I think the relationship between the credit card data and the reported results over time has widened out a bit. And my view is if you're just looking at it and treating all data points the same, you're missing the widening out of the delta. So, I mean, look, they could be right. It could come in a little bit short. But what I would point out is, and they even acknowledge this in the note later in the analysis, that HIMS typically has really good line of sight on their guide. The guidance is meant to be a little bit shy of what they think the closest to the pin estimate is going to be. And they also have the ability intra-quarter to ratchet up or down their marketing spend with some pretty good degree of confidence that they'll be able to pull in demand to meet their guide. So look, the data is the data, right? I think the analysis for the most part is pretty sound. And I thought the deferred revenue adjustment analysis they did was good because the market needs to understand that. But I just think a $30 million miss is not going to happen because, quite frankly, management isn't going to let it happen.
For those who weren't familiar with the Bloomberg second measure credit card data and how this works, is it roughly that they take the same sample of credit cards and track it week over week, out over week over week, so that they're able to determine difference in new customer and returning customer spend? Is that how it's the same credit cards day after day, week after week?
I'm not exactly sure how they get their sample. And that might be part of if the sample's not consistent, right? I mean, so any recurring charge, I mean, they should be able to line that up on it by unique identifiers. So when they do the returning versus new, that should be correct. But again, I think sample size, who's living in that sample, again, I don't know exactly where they get their data, and I don't know how consistent the sample sizing is. So it's tough. And the other thing too, right, is subscriptions are not always static, right? I mean, let's say you're on a 3-month sub, and then you like your product. Could be hair, could be ED, could be GLP-1s, whatever it is. And you're like, you know what? I'm going to be on this longer. So I'm going to now sign up for a 12, or I'm going to change my dose, or I'm going to add something else, right? And so the cadence of the credit card charge might change and the size of it might change. I mean, the other thing that also works for churn, right? The credit card data is going to see the churned relationship later than it happens, right? Because let's say you pay upfront for 3 months, you're on a 3-month sub, you decide by month 2 you're done, right? And you tell HIMS that, but the credit card data isn't going to show that until it's time for the charge to show up. Then the question is, does the credit card sample know that that's a 3-month sub or a 6-month sub or a 12-month sub? It doesn't know, right? Or it could be a 1-month sub. The data doesn't necessarily show that. So there's a lot of ways that the credit card data will be less precise than we would like. But again, I think it's a really good directional tool. It'll tell you when inflections are happening, which I think we're seeing in the January data. But I think it just makes it really hard to get hyper precise with calling a revenue number for the quarter.
Final question on the Bank of America. For those who don't work on Wall Street, you said you're former sell side. So would you be able to talk a bit about how the dynamics of the buy side and the sell side could have led to a report like we saw this morning?
When you're an analyst and you have a rating on the stock, right? You're looking at all of the available data, right? And you're considering it, and you always need to be in a position to change your mind. However, if you're running, if you're looking at the credit card data and you're seeing a potential miss, you're going to report it, right? I mean, so the question is why that report? Why today? They're looking at the data. Looked like it was going to come in light. They're probably getting questions around from clients, how should we think about the deferred revenue adjustment? And so they put out a report, and it was consistent with their view, right? I mean, look, part of the job is you have a lot of imperfect data points that you got to string together, right? And that's the analysis. If it was very straightforward and the credit card data was perfect, you don't need to listen to the sell side, right? So I think they were, doing what I would have done in that position and putting together a framework for how to consider the data. But yeah, it's consistent with the view. So of course you're going to publish it, right?
I guess my question is could the buy side have influenced this at all? Or hedge funds?
Not this specific report, but they certainly could have influenced or been an influence during the downgrade last year. Now we can get into all the reasons why that was, but I believe the downgrade happened when the Amazon news came out. And so look, when the stock was trading in the mid to low 20s, right? I think you got to separate when you're looking at HIMS, you got to separate the GLP-1 business from everything else. And you got to have a view on the quote the core business. So if you think the core business is a really good business, which I do, and I think everyone on this pod views it the same way, you think, all right, well, what's it worth? Is it worth $20 a share, 25, 30? Everyone can make their own assumptions. Has got their view on it. But when the Amazon news came out, oh, and by the way, they were cautious on the GLP-1 business, saying, hey, look, this is temporary. It's going to be a short-term set of cash flows. We're very cautious on it, but we still like the core business a lot. When the Amazon news came out, they were launching an asynchronous D2C option. That was a kind of a blow to the thesis that the core business was safe and fine and a durable business in their view. And that's what led to the double downgrade from a buy to a sell. At least that's what I believe was the rationale. Of course, my view on that is that until Amazon is coming out with personalized compounded products, they're not offering the same thing, even if it's the same actives. You could always, the option to go get generic ED or hair API or active pharmaceutical ingredient via a generic has always been there, right? You go to HIMS because it's a premium product, premium experience. Amazon was only copying the asynchronous D2C motion, but HIMS was that a couple of years ago, but that's not the business today. So my view is that the Amazon offering is not a material threat to the core business. They have got a different viewpoint, which is fine. That's their view. You hear from a lot of hedge fund analysts that are very negative on the core business and have been for a long time. And there's been some incredible short trades to be had, but their view is, look, you can't say that the core business is durable and safe and amazing if Amazon's going to copy it and they've got better distribution than anyone, right? And if they're going to beat them on price, on distribution, that's really tough for HIMS to sustain its momentum. At least that's the argument.
Hey, Jack, I'm very amateur to the world of how Wall Street works, but in the medical world, when we see certain journal articles or research studies coming out from certain publications that have a reputation or something like that, we naturally will kind of pick through what they're saying with a fine-tooth comb and kind of give it extra scrutiny. Does that exist in the Wall Street world? Like when you see a report from BOA, and I think in the past, BOA has been not the most positive on him. Like, do you see BOA has a new report and then you're just like giving it extra attention and trying to pick it apart? Does that happen?
Well, I think they did a couple of interesting things, right? They looked at the credit card data, they ran a regression, it spit out a number, and then they've got their deferred revenue adjustment analysis over the top of that. I think that's all really good framework, right? So if talking earlier about the role of the sell side, your job is to be there to be part of the mosaic of what the buy side should consider. So I think that it's a valuable report in that it, from that respect. So if you're long or you're short, the framework is very useful. The conclusion, everyone can redo the analysis and come up with their own conclusion, right? So I think it's just a matter of, hey, look, obviously we have our view. We think the data matches our view. We're hitting publish. And by the way, here's a framework for how we think about how to think about the deferred revenue impact. It was a very good report. It was a useful report, whether you're long or short. Again, it's clearly had an impact on the stock today. Short's got some red meat. But again, I think if you recreate the analysis and you can come up with a different conclusion if you choose to interpret the data a little bit differently.
Thanks for all that, Jack. I want to move to a zoomed out picture where we consider not just what the stock is doing today, down 5, 6%, 8% on the open on account of a Bank of America report, but like HIMS for 3 years or 5 years. What is this company as we zoom out, and what might it look like down the road? Can you offer a longer run thesis on the business?
Yeah, I mean, look, I think they've created an incredible consumer healthcare brand, right? And as you said earlier, they've created this business that lives inside the high deductible, inside the cash pay portion of the healthcare system. And as long as they stick to the formula, right, is creating a premium, personalized healthcare experience and continue to roll out new product categories, I think you're going to find that, again, Andrew's talked about this a lot. At some point in the future, we hope to have tens of millions of patients and to touch every household in America. They're lofty goals, but look, if you look at the growth, you look at how they've entered new categories and the increasing success that they've had in doing that. Look, there are other people going to try to copy what they do, of course. Are larger players going to try to recreate some of it? Of course. But they continue to execute. You've created this extremely high trust brand. You look at Amazon, for example, right? I mean, they've tried to get into healthcare in a number of different ways. They had their own kind of failed Amazon. I'm trying to remember the name of what they had, but they tried to offer care, didn't really work out. They had to go buy One Medical. Not only did they buy a large physician group, but you got a brand, right? And so that was a very trusted brand within care delivery, and I think it's going reasonably well. But trying to then, as pertains to HIMS, create that D2C branded experience, it's funny because they're delivering the One Medical brand via the Amazon app. It's Amazon One Medical. The problem is you're diluting your One Medical brand by throwing the Amazon in front of it and by routing everything through. Again, look, is someone else going to come up with a trusted, personalized consumer health brand? Yeah, maybe, but I think HIMS has got such a large head start. They continue to execute the way they have. So I mean, this company is going to be a hell of a lot larger than it is today.
You mentioned something kind of interesting to me right at the very beginning of this podcast. I think you mentioned something like consumer behavior is different from patient behavior. Is that kind of what can you touch upon that again? Because that was just really, you got my mind like whirling and thinking about that.
Yeah, consumers, when you shop, I mean, we're all consumers, right? When you're shopping for goods and services, you're in control of the decision-making process, right? When you're a patient, you're just kind of going through the healthcare system. There's a lot of other entities at play that have got more of a say as to what's going on than you do, right? Insurance, what is covered. Your doctor's gonna have a recommendation. You might go get a second opinion. If you're looking for a specialist, it'll be pushed in network within whatever healthcare system you're working with, right? And oftentimes the what, the how, and how much are you're kind of going through a flow that you're not fully in control of, right? But if you're shopping for clothes, you're shopping for food, you're shopping for a car, right? You're in control of the whole thing, right? You're doing your research, you find stuff you like, and then you stick with it. It's a different path, it's a different motion. And it's very clear, look, when I swipe my card, I'm getting X, right? When you're going through the healthcare system as a patient, right? You might have your copay, then there might be a fight with the insurance company and your provider about what's covered and how much. And then the question is, all right, well, do I want that? And it's a convoluted process. HIMS just makes it so easy, right? That the D2C model makes it so easy to understand the direct link between my experience with HIMS and it costs X, right? And I like what I get out of it. It's very simple. It's very predictable. And again, it's not insurance paying, you're paying, right? There's a very direct link between the dollar spent and the care given.
I think that's really a fascinating point to point out, because we have a lot of viewers and listeners from different parts of the world, Europe and Asia and different places where there's a vastly different healthcare system. And I think it's important to mention this, Jack, because the United States healthcare system is so unique in exactly what you say. The typical health insurance plans that patients have often will leave the patients feeling so powerless, like they are not really in control. Even if they have health insurance, like they won't know exactly how much something costs. They won't know which doctors they can see. They won't know which specialist they can go to. They won't know if their medicine's even going to be covered. And even for a vast majority of people who have insurance, the insurance coverage may be poor, so they're underinsured. And even then, the medicine might not be covered. So in many situations, I see people will, even if they have insurance, sometimes opt to just do a cash pay outside of the insurance world for their preferred treatment. And I think that's something very empowering for the person, even though the medicine might cost 30% more than if they tried to do it through insurance. There's that feeling of you're in control and I want to spend this extra money, even if it's not the lowest dirt cheap price of the medicine I can find on the internet, So I think there's something very, very powerful about that psychology.
Yeah, and the other thing too is most Americans with insurance don't know that when you're interacting with the healthcare system, there is a cash pay option. You just never really know to ask about it.
Yeah, it's not offered, and I don't even think the clinics can actually advertise that directly if they do take health insurance. But there's been times when myself, as a patient or consumer myself, not as a physician, but if I'm going to a clinic, I forget to ask, can I just pay cash? And many times the cash option for a visit will be 30, 40, 50% cheaper than the out-of-pocket cost with insurance coverage. So it's just a very complicated system. Just to give context to viewers outside of the United States. I mean, I guess even for people inside the United States, we just don't know about this. And I think that's important to understand about what HIMS is offering as this other option that is very appealing to a lot of people.
Totally. And not to stray too far from the core underlying topic here, but for anyone outside the US listening in, right? So let's say I'm in New York, right? So let's say you're interacting with a health system in New York. There's going to be a handful of insurance companies that have relationships, that have negotiated care contracts. It's basically a charge master and then adjustments off of that. And so one insurance company might reimburse X for a visit or a procedure. Another insurance company might be 20 or 50% higher or lower than the other one, right? And then you do the same thing with the next healthcare system. And so the relationship between the insurance company and the healthcare system could be significantly different depending on, from the patient standpoint, your insurance or where you're getting your care. And then obviously setting matters, right? Whether it's in a hospital or not in a hospital being a major difference, and in what the potential cost is going to be. There's all sorts of different reimbursement issues around that. Not to bore anyone with those details, but the point being is that the U.S. healthcare system is really convoluted. And when you can just simplify your experience as a patient, to make it more like a consumer, swipe your card, you get the good of the service. I mean, there's a lot of headache that gets removed. It's just a much cleaner, more simple and enjoyable experience.
It is so complicated. I've just about opted out at multiple points in the last 5 or 6 years. It's enormously frustrating. I want to ask Jack, do we have any idea if the cash pay option is increasing as a share of overall healthcare expenditure?
Whether patients are just opting to pay cash
whether we consider spending on HIMS and related brands as a percentage of that pie?
Well, I think getting away from just a cash pay versus, say, having insurance involved, I think the way to think about this is the out-of-pocket burden that patients are spending as part of their care, whether they're insured or not, or underinsured. There's really good data on this. Kaiser puts out good data. CMS, HHS puts out data. I think even the number of good kind of government resources on this. And you basically, if you follow the out-of-pocket burden spend over time, and you look at the amount of healthcare plans that are opted into that are high deductible, and that you watch the size of that deductible go up, right? You can see that there's just an steady increase well above CPI of the out-of-pocket burden, right? So if you're going to be spending the money anyway, right, if you're insured, even if you're insured, right, you might as well get a better experience. And that's what makes the HIMS story, I think, so powerful, is that they've created a much better experience for patients because they got to spend the money anyway.
I feel like all of this lends to the idea that HIMS is genuinely competing for market share in the general physician market broadly. And we've called it an AI orchestrated general physician at national scale. And the addendum to that description has been, and soon at international scale. And that brings me to my question for you, Jack. Have you done any work on the viability of the business model internationally? Do you think it would do well in the Nordic countries or Western Europe or any other regions in the world?
I haven't spent a ton of time on it, and the reason is there's just such a large opportunity in the U.S. that international expansion for the sake of expanding internationally, it doesn't need to be a core focus of the business now. I mean, look, they did an acquisition a few years back. They bought some assets in the UK, and I think at the time they were trying to get a feel for, can we expand into Europe? And they haven't really talked about this a ton, but I think what they found was that, look, the way people interact with the healthcare system, the way people think about getting care, is just so different everywhere else in the world outside of the US that there doesn't need to be that much of a focus. I mean, the other thing too is that felt like you're kind of alluding to earlier, was, well, HIMS get into virtual primary care, and that's been a topic in the industry, for a while, whether you'll see virtual primary care tick up, and Teladoc made a pretty big bet on that. You see some of the insurance companies are trying to pull that off. I don't think that that's what HIMS is going to try to do directly. I say directly because if you think about the way they go to market, right? They're advertising therapeutic or product categories, care categories. It's not general, right? And so if you're thinking about the way that your patients or consumers are going to HIMS, they're going to solve a specific condition, right? If you think of general care, right, it could be for a lot of different things, not necessarily a specific care category. But I think, look, HIMS is going to keep adding new care categories. So at some point, you're going to have most of them covered, and then do you just have a virtual primary care offering at some point? Maybe, but I think that day is pretty far in the future. Maybe at some point you have a dedicated GP at HIMS. My guess is, we're 5+ years away from that at a minimum.
You mentioned you might not have listened to all the podcasts, but this has been a point of contention, I guess, on the podcast, because in my mind, it's like you said, it's like, all right, once they have 150 SKUs, at what point do we start calling them a general physician, where you show up to the website and you are in effect dealing with a GP and the AI is orchestrating the interactions? You won't necessarily have to have a devoted GP. It'll be an AI that you interact with over time. I think that for me, that has been like the long run vision for what it could be. But
yeah, I mean, look, we might get there at some point, but what you're describing is replacing the doctor with AI, and I think we are so far away from that. Like, look, I mean, there's a reason why doctors have to go to med school and get their license, right? The AI is not replacing that anytime soon. And whether the underlying technology gets there soon is one thing, but whether society will accept that and whether the the liability issue, right, malpractice potential for that, right? I mean, you're just you have kind of similar battles with the automated driving, right? You have FSD at Tesla. The technology might be there or really close, but whether it'll be generally accepted by society and all the regulations and the legality around it gets figured out. The human acceptance will be far later than the technological capability. And particularly within healthcare, as you know, it's an industry that's consistently 10 plus years behind the rest of the economy in adopting technology. And for various reasons, both good and bad, I just don't see the interaction starting with an algo. There'll have to be a human involved. Now, the algo might be working in the background to help suggest and route, and there's already some of that being done today across the healthcare industry, and certainly with HIMS, with MedMatch. But I don't think you're going to be getting your care from an algo anytime within the next decade.
I
I think someone asked on the Discord channel maybe a month or a month and a half ago, like they're wondering if diabetes care would be something that could be realistically done on the platform like a HIMS. And diabetes is a very common condition that's treated by primary care physicians, GPs, stuff like that. Mm-hmm. And at that time, I was thinking about it. I was like, well, similar to what you said, Jack, the technology might be there in the foreseeable future, but I just don't think logistically it will be realistic within the next 5 years to offer diabetes care on something like HIMS. And my counterpoint to that was also like, there's just so many other easier pathways that are marketable to roll out new verticals and treatment conditions. I mean, people with diabetes, it's a condition that's life altering, yes, but it's not something that gets you excited to go and be like, oh, I want to buy these ED pills or I want to buy this for my hair loss. I just think there's so many other things that are low hanging fruit for him to reach up and just grab and do it within the next 1, 2, 3 years. But I think I do see it as a possibility, but further into the future, like 5, 6, 7, 8 years from now.
Yeah, I mean, I think if you think about what HIMS product categories or their therapeutic categories, right? They're relatively low acuity, meaning that they're, these aren't really medically serious, super serious conditions, right? Diabetics are going to have a lot of different things going on. Like if you're treating a weight loss patient, there might be other comorbidities in there, but they're not necessarily acute, meaning they're not really severe, right? They're not, HIMS today is not a complex care or a high acuity care company. They might get there eventually, but there's so many other lower acuity categories to go after where, again, I mean, ultimately I'll come back to this, look at their gross margins, right? The fact that their gross margins are as high as they are in the 80s for the core business and a little bit below that when you add in the GLP-1s, it tells me that they make their money on selling the script, the product, right? Ultimately, they're a product company that has a little bit of a service wrapper. The more you involve a physician, the human capital, you can't get nearly that kind of a margin on a human than you can a product, right? And I think HIMS wants to protect those margins. And so they will add in higher acuity categories. You create a more holistic care offering, but you have to, they're not going to do that today. They're not, it would be dilutive to the financial model, even if it's incremental or accretive to the patient experience. I just don't see them doing that anytime soon.
I just want to add a little joke here that Teladoc thought the diabetes care was worth $18 billion, which it's a joke, but it's also worth considering. And maybe Jack, maybe you didn't. I don't know what your coverage universe has been, but the Livongo acquisition was very interesting as it relates to HIMS potentially entering chronic care management such as diabetes. Livongo was a wildly successful business. It was doing really well until Mr. Gorovich got his hands on it and literally lit TNT within the business. Like I knew people in Silicon Valley who knew people in the company, and it was like walking into a kitchen full of roaches and turning a light on. They all scattered. as soon as Teladoc got their hands on the company. And I don't mean to air the dirty laundry of Teladoc. I was a part of that thesis, so maybe I am entitled to do that. But
yeah,
very interesting.
I mean, look, I think there's a couple of things here. I think the general thesis going into that deal, right, was sound. You wanted to add a high TAM, high growth asset that could fit onto your platform, more stuff you can sell into your customers, right? So Teladoc's great distribution, 80, 90 million members, whatever it is. And you've got a very high TAM and successful high growth asset that you can plug into that. At the time of the acquisition, both those stocks are trading at just crazy valuations, and Livongo is crazier than Teladoc's. And look, I don't want to speculate too much on what may or may not have happened post-acquisition, but it's pretty clear that what ended up happening post-acquisition was not what they had planned when they were. And look, you look at the Teladoc stock from over the last 5 years. I mean, there's a lot of things that didn't go as well as they certainly thought. But I think the other thing too is, and I think you see this a lot in the rest of the digital health landscape, where you had this massively disruptive event in COVID, where everyone was at home, and your routines were completely altered, right? And so you had these digital, remote, not in person business models that were scaling so incredibly fast. Here's another good example of this, right? And when you see these growth rates, and there's a big unknown about how things will shake out on the back end of the COVID era, and you had ultra low interest rates, which was fueling this. You got just some silly valuations. But you also had business decisions being made that were under the assumption that these conditions would continue, that we had broken the way that people went about their lives or got care before, and there wasn't really a appreciation for things coming back to somewhat normal, right? And look, when money is free, when rates are at zero, and investors are pushing your stock to the moon, you get a lot of confidence that what you're doing is correct. And when the tide starts to roll out, you better hope you're correct. And you look at pretty much every single one of these companies, there were a lot of decisions that were made that did not consider that life would come back to normal, the way that it did. And then you look at what happened with interest rates. And I think the other thing too is, you also, when money is free and rates are low, you can afford to take on some longer term projects that are going to be burning cash for the next couple of years, but could have a big payoff 5-10 years from now. And well, when rates start going up and valuations start to compress, and investors are scrutinizing your cash flow statement more than your revenue, you have to unwind a lot of those projects because the market's not willing to pay for them anymore. Hurdle rates have gone up. I think one of the things that HIMS did really well throughout this process is, it was a massive tailwind for their business, but they were smart in the sense that they didn't blow through all their cash as quickly as maybe some of their competitors, or certainly some of the other digital health companies. I mean, they were focused on increasing their margins, right? Insourcing the pharmacy production. They were growing, I think, appropriately. They were not letting their EBITDA loss blow out too high, or too wide, I should say. And when it did become time for them to start to show that they could be profitable, they were able to do it very quickly, right? Because again, they focused on having a really good experience. They insourcing, so boosting their gross margins. You're creating a scalable infrastructure that could support really nice margin expansion and ultimately some really great cash flow trajectories. Fortunately for Teladoc and Livongo, it didn't work out quite that way.
I want to touch upon Teladoc really quickly, because I was actually working with Teladoc at the time that Livongo acquisition was happening, and chatting with my physician colleagues on the Teladoc platform. We were just scratching our heads, like, how does Teladoc think they're going to make this a successful venture? Because at that time, the technology for Teladoc was not there yet to handle or incorporate any chronic care management or primary care management. The system was clunky compared to HIMS' system. The workflow of how a physician would potentially see a patient for diabetes, follow-up labs, do follow-up appointments, reviewing the appropriate tests, and making new referrals or orders for a heart scan or something like that. We didn't see how it was feasibly possible in the next 1, 2, 3 years to make this acquisition profitable. So we were wondering why this, why now, and it was just we saw the result of that.
Well, I
The
think,
other thing,
one of the things that just, you started to cut you off there, is the big juxtaposition, right, between HIMS and Teladoc when you're doing virtual care, right, is you don't have to deal with insurance with HIMS, right? Physicians don't have to worry about that, right? You don't need to do pre-auth. You don't need to make sure you're billing correctly, right? It's cash pay. Credit card's already been, it's on file. They've already, the patient has already selected what they're going to pay, right? So on the back end, as a physician, right, in fact, you don't have to worry about the revenue piece. I mean, that makes your life so much easier, right?
absolutely. And that's one of the main differences between Teladoc and HIMS too. Going back to what you touched upon, the psychology of consumer versus patient. Teladoc has 80 something, 90 million subscribers, but the vast majority, I think, of those memberships it's covered through a benefit as part of their health insurance. They say, hey, you're part of Blue Cross. We're going to give you this free membership to Teladoc. And I remember being on that platform, Teladoc, the vast majority of the patients on Teladoc had what you would call the patient mindset. They felt a little bit more powerless about how they were navigating the healthcare system. They weren't consumers. They were trying to find the cheapest, lowest cost thing to get their cough or flu symptoms resolved. Teladoc did not have a way to make money or revenue off of this recurring treatment. On Teladoc, the doctor would prescribe a $5 antibiotic and send it to their local pharmacy. So Teladoc's not making money through that recurring revenue. So there's quite a bit of difference between the models. Some people might be impressed with the 90 million subscriber base of Teladoc, but it's a very different psychology of that type of patient versus a 2 million subscriber base of consumers on HIMS who are happy and willing to open up their wallets for this more personalized care.
Yeah, that's a great point.
I just want to say, Jack, I think HIMS House and your psychology are very similar. Like, this has been such a great podcast. So many of the topics we've discussed, we've worked through on past podcasts. And I think we really see eye to eye in a lot of respects, in a nuanced way, in a way that has been rigorously discerned over the last few years. So I just want to say we really appreciate your perspective.
Yeah, I mean, I love this whole consumer versus patient psychology tidbit that you threw in here. It really kind of goes to kind of address people's fears about not having a moat for HIMS. So people say, can't any company just give a generic medicine and do it cheaper? Yeah, well, this kind of addresses that whole psychology behind that, I think.
Well, yeah, I mean, look, I think that to even press this topic a little bit further, right? I do wonder how many people who were short HIMS for the GLP-1s had never gone through the customer journey, patient journey, and that weren't subscribers or customers themselves. Because I think once you realize, okay, this isn't just convenient, I don't have to deal with a doctor face to face. Easy way for me to get my ED meds, my hair loss meds, mental health, whatever it is, right? They think, oh, well, that's all they're offering because it's the same stuff I can go get at CVS. It's like, well, I don't know. Is it really? Like, sure, you could go get your generic Viagra at CVS. You have a fun conversation with your doctor. Or you could get the hard mints from HIMS. Got a couple different actives. You can dial up or down the dose and the ratio between the two. Comes in a tin, not a pill bottle. That's actually a hell of a lot better experience, right? Or the hair, right? Oh, I can get Pisha delivered locally via the spray versus having to take a pill, which I would get, at CVS, right? And I don't have the same side effects I used to have. Well, it's a different product, right? It's a better experience. Like you have to compound a personalized medication in order to pull that off. You can't get that at CVS. You can't get that at Amazon.
I think the people that are kind of bearish on this, I think, get really focused on it being a black or white issue. Like, trying to pigeonhole every consumer or patient into one mentality. Like they just want the cheapest medicine. And I think consumers are becoming more savvy when it comes to their healthcare. And I think
Totally agree.
they are more knowledgeable of what the options are, and they can then decide and make their own personal decision of how they want to spend their money. For instance, just to throw an example, if there was a generic medicine that met their needs and treated them well, they might decide, hey, for this specific medicine, I only want the generic, and I'm going to get it from Amazon. I'm going to get it from Mark Cuban's Cost Plus Pharmacy. But for this other condition I have, hey, I don't want the generic because I really like their hard mints and I like how it activates quicker and tastes better. I'm going to spend my money on a slightly more expensive combo Viagra with Cialis formulation through HIMS. So I think overall, people are just more in tune with healthcare and are savvy enough to navigate, or are becoming more savvy to navigate and decide where and when they want to spend their money.
Yeah, I agree. And just to put a bow on it, that patient experience and then that personalized product that you're getting, that is the moat. And look, there are other companies that do similar things, right? Row has their, I think the Sparks products, right? That's another platform that, by the way, pre-pandemic had more revenue and more cash than HIMS, but they gave up their leadership position because they weren't focusing on all the same things that HIMS focused on. They were chasing COVID testing. They had the at-home phlebotomy business. I think they've really, just as an aside on Row, they've kind of reinvented themselves as trying to be a complex care company, right? So they're leaning really hard into weight loss and diabetes. They want to be the service more than they want to be the pharmacy, right? I mean, HIMS, at the end of the day, it's an online pharmacy business. The reason why the margins are in the 80s. When you become a service business, you got lower margins, but you also may have a different recurring revenue model as well there, right? Yeah, I think Row, they're gonna have a really good business for a long time. That category is not going anywhere. And with the advent of the weight loss drugs that actually work, the GLP-1 category, it's a really, I think you're going to see more patients getting treated for obesity and diabetes, because there's more to offer than just diet, exercise, discipline, right? Now you can get that more holistic care delivery. I think that they've found that is a more attractive business for them. HIMS has got their very attractive business. They've just, again, they outcompeted Row and everyone else. And again, I think people are going to try to do what they do, but HIMS got such a head start now, and they've created such a trusted brand that it's going to be hard to catch them.
In your mind, is that why Row kind of partnered with, I think it was Lilly recently, for their little agreement there with their Menace GLPs? Like Row's intent is to be more of a service provider.
Well,
is that what you're thinking?
I think they made that clear when they came out with the body program, right? So the body program was their entry into the GLP-1 category. They wanted to be the companion care program, right? Because you think about it, right? Really expensive drug category. The idea in the long run is that insurance will pay for your GLP-1, right? But you think about the GLP-1 category from a payer perspective, right? So think of it an employer-sponsored health plan, the insurance you get through work. What we know with these drugs is that A, they're expensive, B, adherence isn't great, right? Let's say you lose your weight in 3 or 6 months, whatever it is, you go off the medication, right? You've hit your goals. You go off the medication. If you didn't change your lifestyle, you didn't change your habits, your appetite comes back. And if you weren't going to the gym and you're eating poorly beforehand, you're going to put that weight back on. And oh, by the way, when you're losing the weight and you've been in the gym and you haven't been eating healthy, you've lost muscle mass, right? So as you put the weight back on, you're not putting the muscle mass back on. So as you yo-yo, you're actually creating a worse body composition. You're in a worse place than you were before you started the drug. So insurance companies or your payers, employers' health plans, when they're considering covering the category, the idea is that, okay, you have either a step program, meaning you have to start a program like a body program. Weight Watchers got something similar. Noom's got something similar. There's other private companies like Verta and Amada and a handful of others where you're pairing the drug delivery with a behavior change program. And I do think that in the long run, as employer-sponsored health plans and other payers are covering the category, it's going to be mandatory. And it'll be part of your pre-authorization process to be on a behavior change, a companion care program. Because when you're on these drugs and the drugs work really well, right? You can lose a ton of weight in a relatively short period of time. But if you pair that with behavior change, you can get the long lasting results. And by the way, right, as we all know, when, obesity is the leading reason why you develop all these other comorbidities. If you knock that out, all that care cost, that downstream care cost goes away, right? So it's a massive win if you're taking the actuarial risk on this patient population. But you need to get the patient to play ball as well. There's one thing we know with Americans is that, I'm sure this is probably true everywhere else in the world, we're bad patients. We're gonna do the right thing last, right? And if there's an easy button, we're gonna press it, right? And so if you say, hey, look, you get the easy button, but you jump through these hoops and you have to create a new routine, create new habits. Those habits live on. And that's when everyone wins. The patients win, the payers win. Obviously, the drug companies still win, right? Because it's a massive category. They're going to be, some people will be on the drugs for life, probably most won't. But it's just you get that, the more insurance coverage, the more new drugs the drug companies can sell. It's a win for everyone.
Yeah, and the employers that sponsor these health plans will win just due to the economic gain from not having a chronically ill person missing work days, doing their cardiac rehab or recovering from a heart surgery and things like that. So I think you're right. Everyone wins up and down the line there.
Well, yeah. Also, when you're in shape and you've got more energy, you can focus better at work, right? I mean, you also just get a productivity enhancement for your employees being in better shape, and there's a certain podcaster would call it your meat jacket is in better condition, right?
We're pushing up on an hour here. I want to close with 2025 predictions. You were messaging me privately and talking about some app data that is extremely important to be tracking, and all the more important because it's January. Can you discuss that a bit? Key indicators that we should be tracking, and then zooming out a bit, what are you keeping your eye on in 2025?
2025 is going to be a really interesting year for HIMS. I think the stock is going to be incredibly volatile for a number of reasons, right? January is massive, absolutely massive for the weight loss industry. It is the Super Bowl, the last week of December, the first 3 weeks of January, the New Year's resolution effect, right? This is the Super Bowl. We're in it right now. And so the credit card data, the app data, the web traffic, we need to see that spiking. And I think we are seeing that.
To give context for that, we're seeing that on a lot of small platforms that are offering GLPs. There is a queue of, just a week ago, 8,000 patients waiting for GLP-1s for these small companies that I work with. Typically, the queue is like 200, 300. So even these small companies are making their Super Bowl killing, 8,000 people waiting.
Yeah. And the goal there is to get those patients and then keep them, right? Because one thing we know about diet season, weight loss season is typically short-lived, right? You get all the gym membership signups, and then people aren't there by March. So the goal, for all these guys is going to be able to keep them, similar, to HIMS. So obviously you've got that, right? And then we've got the regulatory shortage list. Yeah, I'd say overhang on the stock. Obviously the FDA is going to have to come up with a decision of some kind around whether semaglutide will stay on the shortage list. Right now, all doses are available, yet the drug is still in shortage. The FDA is figuring out whether to create a consistent supply to match demand. That's probably a discussion for another podcast. We'll have that. Then the question is, right, how much semaglutide will HIMS be able to sell in a post-shortage environment? I think that there's still probably a raging debate on that as to whether they will be legally allowed to do that. There will be a set of lawsuits that come out across the industry challenging the legality of the personalization exemption. That's a fight for another day, but that's coming probably sooner than the industry would like, but we'll see. Obviously, we got the new administration. They've got a little bit of a different view on this category than the prior administration. So we'll see what happens at HHS and the FDA as regards to the compounding industry, specifically this category. Yeah, then as we're looking further into the year, we've got the potential launch of the hormone therapy category. I think a lot of us are really excited about that. Don't believe any of that is in consensus numbers, probably not in the stock. So that'll be really, really interesting to follow. And then look, I mean, yeah, I haven't even, as far as the outlook goes, I haven't really talked about the rest of the business. And I think under the surface, the rest of the business is still doing really well. Look, bears will point to a declining growth rate. It's like, oh, okay, but you're still growing in the mid 30s this year, I think. Some people probably think maybe in the 20s, but look, again, going back to all the things we talked about earlier, this trusted brand that's done extremely well, scaling margins. I think they're doing a really good job with their CAC. I'm not all that worried about the Facebook targeting issue. The healthcare category is one where they're going to be a little tighter with the advertisers' ability to target just around personal identifiable information. HIMS, when they go to market with their marketing and advertising, they use so many different platforms, so many different channels and they've got a really, really great, I think, TV and print and podcast advertising strategy, really good SEO that if they're not hitting as many potential customers as directly on the Facebook platforms, they're hitting them elsewhere. I don't, it can be mildly disruptive. It'll probably be a little bit of a headache internally, but I think they're going to figure it out very quickly, and probably faster than most in their category. So I'm really not honestly worried about that much. I don't think they've come remotely close to tamming themselves out within their core ED and hair loss categories. I know that was a bear thesis for a while. They're just massive categories. We're not close to seeing them hit their TAMs there. Growth rate's slowing, sure, but still growing mid 20s easy in both those categories by my estimates. Yeah, I think the HERS business is underappreciated even before you bring in hormone therapy. It's such a fantastic business. They've really, I think, done an excellent job of understanding those customers, those patients, and how they interact with the platform, how they interact with the brand. I think it's just an underappreciated, underlooked piece of the business. And look, I think that the natural lift in margins is really also underappreciated. Yes, they've committed to 100 to 300 basis points of marketing leverage, gross margins, ex GLP-1s. I think will stay in the low to mid 80s. They'll give some price back as their fixed cost scale, but I think the natural lift in the core business is at 200 to 400 basis points of EBITDA margin over the next couple of years, with the new categories and GLP-1s kind of diluting that on a consolidated level into a couple of basis or a couple of points of margin expansion per year. But look, there's the other thing too is what we've seen time and time again with the way they manage growth and margins is that as they're growing above their guidance targets, they're reinvesting most of that back into customer acquisition. And so they're not going to let the margins escape too high too fast. So again, with the natural margin lift in this business, it'll get reinvested. And the core business, I think, is going to really surprise the market to the upside, irrespective of what happens with the GLP-1 business this year.
Yeah, imagine 5 years down the road, we have stable 20, 25% EBITDA margins, 15 to 25% growth year in, year out. I mean,
yeah, look, I don't think they're going to let themselves get to 25% margins by the end of the decade. The growth rate will be too low at that point, right? They are going to keep this at, I mean, look, they could, well, yeah, but not 25% margins, right? I mean, I think you're going to see, for a lot of reasons, I don't think you're going to see a 25% margin for inside of 5 years. Again, I think the natural lift in the business will be there, but they're going to, again, reinvest those dollars back into growth, right? If you want to be a business that has tens of millions of subscribers, you're not going to let your margins get too high because you're leaving growth on the table, right? I mean, they could be there today if they wanted, but you would then be a mid-single digit grower, and that gets valued completely differently than a 30+% grower with gradually expanding margins. I have full trust and confidence in this management team. I think they absolutely get it as it pertains to what investors are looking for, the trade-offs between growth and margin expansion. And again, they just need to continue to show steady margin progression, getting as much growth as possible with that in mind. And look, I do expect them to continue to beat and raise, with most of the raise happening at the growth line, not as much on the margin line, but I do expect some beats on the margin line. Again, the EBITDA dollars will be going up a good amount, and will be beating by a good amount, but the margin of those dollars will not be nearly as high. And I think that's, again, reflective of them trading the too much margin expansion for more growth. A good data point to show that is when they were raising guidance this year and even last year, right? So the fourth quarter EBITDA guidance basically doubled from what was implied in the second quarter, right? So you get your second quarter results, you guide for the third, you get your full year, you have an implied fourth quarter guide. They doubled the initial implied EBITDA dollar for the fourth quarter, but the margin was pretty consistent. It was up maybe a little bit. So that's my point there. So the EBITDA dollars will continue to go up, and from a guidance and a beating perspective, but I would not expect the margin to beat by nearly as much.
Well, we are well over an hour. I think, I speak for myself, but I imagine Lewis and Dr. H would agree that we could go for hours longer, but I don't know that we can. And out of respect for you, Jack, thank you so much for your time and for coming on the podcast. It's a real treat to get to speak to someone that is on Wall Street, having discussions with the people that write the reports that move the stock, and your perspective is a considered one, and want to thank you so much for coming on the show.
Yes, I was gonna say thanks for inviting me on, and it's hopefully anyone listening, the perspective is helpful. Again, think of it as this: it's perspective, and I'm trying to help provide a framework for how I think the business is being managed, for the opportunity, and again, opinions. it's definitely my opinion. I think this is a fantastic company. The stock is going to do what the stock does, but look, I think the future's bright for HIMS.
Well, Jack, thank you again. This has been HIMS House, episode 19. We'll see you next time.
Thank you, Jack.
Thank you,
guys.